the number one predictor of success was really their ability to adapt. And there were four pillars that we really came up with, and we can dig into these as much as you want, but four pillars that we really determined this is what makes a founder successful over the long term. This is what helps the founder scale. Number one,
hey, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes with Angel Investors Network. Really excited about this episode with Greg Moran, and we're going to be talking about 4 key factors for success, whether you are raising capital or investing in a company. These are the things you're going to want to look for to hopefully ensure the success or the more, I'd say, greater likelihood of success whenever you're investing in a company. So stick around, listen to what Greg has to say, and he has a special offer for you at the very end as well. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Hello, and welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm here joined today with Greg Moran. How are you, Greg?
hey, Jeff, how are you? Thanks for having me on.
Absolutely. Pleasure to have you on here. I'm really excited to talk to you about your new book that's coming out, The Adaptive Innovator, as well as some of the things you've done in the private equity world and or the equity world in general and raising capital and running businesses and all of that. So before we dive in, why don't you tell folks a little bit about your background?
Yeah, sure. So, serial entrepreneur really is where I started. I've started multiple companies throughout the years. I've been fortunate enough to have a couple exits along the way, primarily around those businesses were all tech companies, primarily around the future of workspace. So, hiring, development, things like that, mostly within large enterprise companies. So, primarily SaaS companies. Sold my last one in actually, oddly enough, on February 28th of 2020. Which, if you remember what that date looked like, it was a bit out of control, the
Yep.
pandemic. But we closed on the sale to a large private equity firm and stayed on for about 18 months. But really, what I wanted to do, Jeff, was really focus on kind of moving. Over the years, I had raised about $500 million in capital for various businesses, and wanted to move to the earlier stage venture side and start investing, but also really provide a mechanism to allow really world-class founders to have a little bit easier journey than I did. And that's where we started Evergreen Mountain Equity Partners. So it's we're an early stage venture, pretty much seed, early stage Series A, but with some really notable differences in that we do come from a real strong operator pedigree. We're not your kind of venture guys who came out of, Ivy League schools and went right into that world. We built companies over the years. We've exited companies and we've made all the mistakes along the way. And what we really wanted to do for founders was really be able to help them, like I said, give them the resources that they need to be able to have an easier journey, whether that's playbooks and advice and coaching and just all the stuff that I needed as a founder. So that's really what we did with the firm. And that's actually kind of where the book originated from. We'll get into that, I'm sure.
Absolutely. Well, wonderful. You have a great background then. And it's interesting to hear that you raised a lot of equity or a lot of capital for a number of companies. And then after a while, then decided to go into the startup world. I'm assuming you obviously started a number of companies as well, but a lot of people, they don't generally do that. They don't generally have, and I'm one of those strange ones too, where I was in the big business world and I actually helped with raising capital and investing before I actually set out and became an entrepreneur. So,
Yeah.
talk to us about why you made that shift to say, okay, I want to go and help more founders. I want to go and shift over into this startup early stage world where, let's face it, it's a lot of hard work. It's a lot of challenges. And there's always people that need money and need help, but generally they're the ones that don't have the money or have the experience to make it all happen. So
That's
give
right.
us a sense for why you wanted to do that.
Yeah. I've worked over the years with a lot of angel investors, seed investors, Series A, Series B, Series C, and beyond, large private equity. So I've kind of run the gamut. The common denominator that I really saw was, while every one of those firms, without exception, every single one of them talked about how founder friendly they were. Almost none of them actually know what that really means. And when I say that, whether it's, I think on the angel side and the really early stage investor side, they want to help, but often they really don't know how. Um, when you get into early VC, it's really about kind of building a large portfolio where, returns are going to come on the upper end of the bell curve. Everyone else is going to die off, and you're kind of okay with that. As you get into larger private equity, you get into playbooks and things like that. But what I really wanted to do, and kind of the passion behind this, was maximize the ability for founders to be able to build. There's, when you're in the early stage investing world, whether you're an angel investor or you're a VC, early VC, there's really two primary things you need to de-risk for. And there's more than this, but there's really two kind of broad buckets, right? Number one, you've got to understand the founders that you're investing in. And there are particular attributes that make a founder successful and that you can use to help predict the performance of that founder. Number two, you've obviously got to look at things like product market fit, timing, right? So there's sort of the business side of it, but that other side, that founder side is I would argue, far more important than the other side. I've seen founders with not great businesses go on to be really successful because they knew how to pivot, they knew how to adapt, and we'll get into this. Where I've seen great, brilliant business ideas with the wrong founder behind it that couldn't develop, and the business as a result suffered. So that's really what our passion was, to really help identify, coach great founders to go on to build great companies. And that's what the fund we built is really all about. And that's why with the, we put a lot of research and a lot of science behind that prediction. We'll talk about that.
Yeah, I'm really excited to get into that because here's what I found. It's the same thing you said, which is we bet on the jockey, not the horse, right?
That's right.
Because you might need to swap out horses along the way, right? Pivoting and all of that. And I wonder about this regularly because I agree with you 100% that you have to have that founder that has the mentality, the fortitude, the motivation, the attitude, the persistence, the drive, all of those things that are necessary, as well as some business acumen and sense and things like that, but not pig-headedness, right? That's the way I look at it. Is there's some founders that are like so stubborn about like, this is the way it's going to happen. This is the business model. This is what we're going to stick to. And come hell or high water, we're going to make this work. And those are the ones that I find that they may even raise a lot of money. There's companies I know that have raised hundreds of millions of dollars with that type of founder, only to fail because of number two, like you said, which is it wasn't the right time, or they didn't know how to sell, or didn't know how to attract enough customers and get market penetration, things like that. So talk to us a little bit. I know this is probably diving a little bit further into the conversation already, but how do you identify those traits where they're like really persistent, really motivated to succeed, but still malleable, coachable, I call it, to where they can make those pivots as needed?
Yeah. So one of the things, Jeff, that we learned really early on in doing this. So I mentioned before that I come out of the kind of the HR tech future work software world. And the businesses that I've built over the years, I've built a couple businesses around behavioral assessment and predictive modeling of performance. And what we wanted to do, early on with the fund, what we wanted to do was say, hey, can we apply that sort of model? There's so much conventional wisdom that goes around, and can we start to break through a lot of the noise in what it takes to be a great founder and start to apply a little bit of science to this? You look at, I talk to angel investors all the time, or primarily where you don't have sort of institutional money or something like that there. And you hear this kind of common refrain of, hey, I'm looking for the next Bezos. Hey, I'm looking for the next, Steve Jobs, or I'm looking for the next Elon Musk. It's not going to happen. That's like trying to find a good scientist and looking for the next Einstein or something, right? They are multi-generation founders. That they are not, you don't have to find that to get great returns as an early stage investor, or you don't have to be that to build a great company. So what we set out to do.
Well, and can I pause you really quickly there?
Sure.
Because it's not only are we finding these people are, that they're, a needle in a haystack, to say the least, but I don't think you would have identified them at their early stage in their career as being that potential.
Absolutely.
I think there's a lot, because I've had people come to me and like, I have no idea whether you're going to succeed or not. I don't know if you're like a Mensa genius or if you're just crazy, right? And so it's really hard to say, I'm going to look for that person, don't you think?
100%. You can't, you can't identify it because those individuals developed into that, which is the whole point
exactly.
of, when we call this framework that we've created called the Adaptive Innovator. The reason we call it the Adaptive Innovator, because if you look at the primary reason that companies fail to scale, it's not because they had a bad idea necessarily. It's not really because they didn't get the timing perfect, because nobody ever gets the timing perfect. It's because the founders didn't adapt to the pace of change. So let me give you a real life example, right? In my own world, the first time I had started a company, the first time we had gotten to $1 million in revenue was the first time I'd ever run a company with $1 million in revenue. When we got to 5, it was the first time I'd ever run a company with 5 million in revenue. Yeah. Same at 10, same at 20, same at 50, right? That's the journey of a founder. You end up having to figure this stuff out as you go, because you're not coming out of, running large businesses typically. And, some people do, but it's this journey that a founder goes through. So what we wanted to do was step back and say, what are the things that really predict a founder's ability to adapt, right? Somebody even coming out of a large company like yourself, right? You had mentioned, you go into a smaller company, you've got to adapt. It's a very different business. Yeah. Same goes. So what we did was we went out and we identified about 50 plus founders who had multiple 9-figure exits over the years, right? So kind of by any financial measure, at least, you would say these are founders who knew how to scale a business. And we started really trying to study those founders and said, what are the common denominators that those founders really all have? And what we found, interestingly enough, was it wasn't this stereotype of, these larger than life figures, right? The Jobs, the Musks, the Bezos. Those, like I said, they're multi-generation founders, right? What we found is that there were common denominators. The number one predictor of success was really their ability to adapt. And there were 4 pillars that we really came up with, and we can dig into these as much as you want, but 4 pillars that we really determined, this is what makes a founder successful over the long term. This is what helps the founder to scale. Number 1, creative resilience. The interesting part of these founders is the harder things became, the more creative they actually got. Not only, there was this sort of persona that they almost needed to get punched into the corner, right, in a sort of boxing metaphor, in order for the fight really to come out, right? And that's what that brought about, that the challenges really brought about this immense amount of creativity for them to start to look for those pivots in a really rapid way. Sorry, go ahead.
I love that, because I've been, on this journey myself as an entrepreneur and a founder and investing in other companies. Excuse me. And I used to have this saying, because I got this when I was in my 20s, probably, learn from other people's mistakes. Life's too short to make them all yourself.
Yep.
And on the surface, that sounds great, right?
Right.
But here's the thing. Like you just said, until you get punched in the face, you don't really know what you're made of, right?
That's right.
Everybody likes to talk about Mike Tyson's quote, but most people haven't lived through it, right? And as an entrepreneur, you can hear that a million times and be like, yeah, I totally agree with it. And then all of a sudden something happens, right? You can't make payroll. That funding you thought was going to come through didn't come through. The marketing strategy or plan that you put in place didn't work. You never got to see, like, I remember when I was raising capital early on, I was talking to people about, because I wrote a book on investing in real estate through your retirement plan.
Mhm.
I would hold these local events and I would have no one show up. Even though
Right.
we had 50 or 100 people register, I have no one show up.
Right.
It's like, oh man. And it's things like that you have to go through it
Yeah.
before you realize what you have to do to succeed and what you're actually made of. So I love that that's number one on your list.
It's so important, right? Because the journey of a founder is that constant. Look, no, the one thing I tell founders all the time is I don't know what's going to work when I invest in a company, and we talk about this with founders openly. The one plan I know isn't going to work is yours. I don't know what actually is, but we're going to learn those lessons together, and that's what creative resilience is really all about, right? It's
Yep.
taking the punches in the Tyson parlance, right? Taking the punches and being able to react with creativity, right? To accept where you are, not fight it, and then start to get more and more creative. The second one is humble, what we call humble assertiveness. Humble assertiveness is a really interesting one, right? Because this is where the model really started to break from the kind of stereotypical founder mentality. Great founders, we saw founders who really know how to scale, they don't have to be the smartest person in the room. They don't have to
Amen
be
to
the
that.
loudest voice in the room. When they assert themselves, it's going to be for what matters. And the rest of the time, they're going to step back and they're going to let their team execute. They're not
Yeah.
going to try to get in front of their team at all costs. They're going to let their team do 90% of that decision making. One of the things to talk about with founders all the time is this concept of meta versus micro decisions, right? As a founder myself over the years, it's so easy to get bogged down in these micro decisions, causes massive decision fatigue, right? It's this 1,000 things coming at a founder every single day for these little decisions that need to get made. What great founders do is they get really clear about what are the meta decisions where I need to involve myself. Let the team focus on those micro decisions. That is really the key. They don't have to be that loud voice. They want their team. They expect their team to drive it. They're going to focus on those big decisions that really matter. So that's what
Which I'd
humble.
imagine that kind of goes right into, and I always get them mixed up. I don't remember if it's a Stephen Covey thing or a Jim Collins thing. I think it's Jim Collins, which is, get the right people in the right seat on the bus, right?
Right, absolutely.
And I think I agree with you 100%. However, I also struggle with a lot of founders don't know how to build the right team to begin with.
Yeah.
And I think that's where some of them go south. But anyway, continue. I love that's a really important point to make.
Yeah, and look, that to me, like building the team, that is a great example of those meta decisions, right?
Mhm.
Building that leadership team, really spending. A lot of founders don't pay this nearly the amount of time they should. They look for, there's just a lot of we could do an entire episode on sort of the common mistakes that they'll make when building a leadership team. And I only know that because I've
Yeah,
made every
I probably
single one
lived
of them.
most of them.
Yeah. No, I mean, I'm with you. I mean, I can't even tell you, right? But those are the meta decisions, right? Because if you can free yourself up, that's the key. Third area is
Okay,
really
well,
about.
really quickly before
Yeah.
you go on, because as you're saying this, you know, I hear people say things like, I wear the same clothes every single day, so I don't have to make too many decisions throughout the day, so I can. And I find that one to be a little bit ludicrous, right? Like, come on, you bought the clothes, you liked them when you bought them, put them on, or get your wife or your girlfriend or somebody else to dress you. That's. But to your point, there's a million decisions that a founder needs to make almost daily, right?
Yeah.
And I love that, especially if you build the right team and then trust the team and the meta decision, making this big picture. Hey, here's the vision. Here's the map. Here's where we want to go, right? I'm in Seattle. We're going out to, let's just say we're going out to Denver near where you are. I'm going to say that's where I want to go. But it's not up to me to necessarily choose every single twist and turn and road we're going to choose. You're saying set the goalpost down there somewhere and then have the team help with ironing out how we're going to get there.
Two metrics, two things I talk about with our founders in our portfolio all the time. Number one, get super clear on your North Star. That's your purpose, right? Where are you going as an organization? It's the boundaries for the organization. right? Get super clear on your North Star, spend, just be talking about it, communicating it to your team constantly. Number two, get super clear on what we refer to as your horizon metric, right? It's that one roll up metric that you're aligned on with your customers. It's the reason your customers buy from you, and it's how you operate your company, right? That horizon metric. Get really super clear on those two things, communicate them constantly to your people. I had a mentor of mine years ago used to have this great saying. It said, you haven't said it enough until your team starts rolling their eyes at you. Then you're just beginning to start saying it enough, right? That's
Right.
where you need to be focusing. And because again, those are the meta decisions. And then build the team around it, and then get the hell out of the way. That's
Love
the
it.
part where founders fail to scale.
Right.
Next one is really around balanced risk taking, right? So this is the third of the four pillars. That, it's not every day in a startup, every day in a high growth startup company should not be bet the ranch, right? Every single day, every decision you make should not be a decision where you're betting the entire company. But there's this mindset, this like chaos, this sort of chaos mindset that so many founders have, right? Where they're coming in and the adrenaline rush of making those life or death decisions every single day, they really cause chaos in the company. They cause chaos in the mindset, in the mind of the founder. They get the company off track. What great founders do is build an incredibly strong foundation for their business and then really start to experiment on top of that foundation to see what else they can start to add to it. That's really about balanced risk taking, right? It's about making decisions. One of the things I talk about with founders all the time, rule number one, if I've invested with you, rule number one, don't go to zero, right? Because if you go to zero, it's game over. Don't go to zero. But there's this Silicon Valley mindset that kind of got into the world, and you still hear a lot of investor types talk about it. And it's, I think, the worst piece of advice that I was ever given and I've ever heard given to somebody, and that's fail fast, right? This concept that people tell founders, like, there's some glory in going out and like slamming the gas down to 100 and running straight into a wall, that somehow proves something. Startups are iterations, right? And founders have to be able to iterate. If you use that mindset of fail fast, you're going to go to zero. And you're not going to
Right.
have anything to iterate on, right? So balancing that risk taking. The last one is really around strategic accountability, owning your decisions, not, pinning them on your board, your investors, your team, owning the decisions that you're making and not being afraid to stand up and say, I got this 100% wrong. Help me understand where this went off course. Great founders are the first person to accept the responsibility as soon as it occurs. You have to be able to. And this, Jeff, goes to where you started this, where we were talking, and kind of the way that you were explaining founders. This goes to coachability, right? If you're not accountable, you're not coachable. And
Right.
if you're not coachable, in my world, you're not investable. It's just a really critical part of that persona of a founder. So those are really the four pillars: creative resilience, humble assertiveness, balanced risk-taking, strategic accountability, right? That's what you're
I
looking
love
for.
that.
That's what we look for in a founder.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
And finding that, of course, is always a bit of a challenge, helping them understand that. But I want to go back to your point number 3, which is that balanced risk taking. So my first career was as a submariner running a nuclear power plant on a submarine in the Navy, right? And you want to talk about being as risk averse as you can possibly be. Talk about working underwater on nuclear power with warheads and everything else going wrong. However, and this was something that I don't know how to impart this to other people, but what you said is very similar to it, which is, when you're working on nuclear power, you do not want to bet the farm. You do not want to risk and hope that something's going to work out and trying something new and doing something innovative, so to speak, right? However, if something happens, you better know how to react very, very quickly and be willing to adapt and be creative with a solution and things like that. Like I'm talking steam starts coming out of a pipe.
Yep.
It's not like you shut the whole thing down and be as, risk averse as you possibly can. It's like, no, we got to fix that because we're underwater and we can't just like stop. So there's procedures around that. So even though there's a procedure and a process, there's still this need for you to think for yourself, to be reactionary as necessary, proactive where possible, and still risk averse. And and then I went into the insurance world. So again, my whole world has been around, the idea of risk, which is first, how do you avoid the risk if at all possible? If you can't avoid it, how do you mitigate the risk? And if you can't mitigate the risk, how do you accept the risk and live with the possible consequences, right? And there's so many ways to go about that, but I love that you have a framework around that. So let's talk about how that has helped not just you, but also when you're doing these research and these founders, like how has it helped to, maybe empower your decision-making process as an investor, as somebody who takes positions on these companies and so on?
Yeah, I mean, from an investor standpoint, one of the things that we that we look to do, right, is, and this is common for early stage investors. I mean, we really, a lot of this really influences the way that we invest. So, we use the assessment to have founders go through it to really try to understand them. We coach our existing founders around this, around this framework to help them. Some found like us, like all of us, right? Some of us are much stronger in some areas than others. Same for founders. Some of this comes very naturally. Some of these pillars come very naturally. Others don't come naturally at all. So we really try to coach around that. And, we really spend time trying to help the founder understand, look, if you will use balanced risk taking as an example, right? To really help them think about how they make decisions as, the way that they go about their decision-making process, that this is not just making impulsive decisions to move fast, right? This is about really understanding what are the short, middle, and long-term implications, but also exactly to your point, what's the risk in this decision, and then how are you going to mitigate this risk? Because there's probably a better chance it's going to go wrong than right? That's the nature of a startup. How are you going to offset this risk? Jeff Bezos has this great saying, right? I talked about Bezos a second ago. He's got this great saying, right? It's understanding the difference between single door decisions and two-way door decisions, right?
Revolving doors.
Revolving door. Thanks. I forgot the word for that. The single door decision, right, is once you go through that door, it's going to be really hard to turn around and get back, right? Who you take financing from, a key executive hire, an acquisition, things like that, right? Those are one-way door decisions. The rotating door decision is really, it's the decisions that, hey, if you make them, the stakes aren't that high, we can undo it quickly. It's helping founders really understand the difference between those two decisions. If it is a one-way door decision, we want to make sure that the work has gone into it, and we also want to help them understand, is there a way to turn that one-way door decision into the rotating door decision? So, I mean, that's the kind of thing, and that's how we really try to put this stuff to use. It's helping them not be afraid to take ownership of their decisions, not, having them feel like they're on the verge of getting tossed out of their own company at all time if they do anything wrong, right? It's, there's coaching there. It's, telling them, giving them coaching when we see them interact with their team. We always want to have board meetings with their team involved because we want to see how are they interacting with their team. Sometimes it's telling them, hey, shut up, right? Let your team talk. Like, you don't need to be talking. As a matter of fact, you want to hear from them, not you, right?
Right.
It's that kind of a thing. So we really try to put this into action on a daily basis, and we use this as a real foundation for how we talk about balanced risk taking, how we de-risk our investments as an investor, because we got to get this one right. We got to get the founder right. If we got the founder right, there's a lot we can do with that business, even if the business, even if stuff happens strategically that goes wrong.
And that's one thing that, I've sat through thousands of pitches.
Mm-hmm.
I'm sure you have too.
Yep.
And I've listened to really, really good ideas that have never gotten any funding.
Right.
And I haven't done a full blown research or analysis of that, but my gut tells me when I'm listening to the pitch and then I'm following up with the founder and whatnot, and then I'm watching the investors in the room because we hold these pitch days and pitch tanks and things like that. And what I'm sensing, again, I have not done the full analysis like you have, but what I'm sensing is that there's something that is unspoken that is causing people to not believe the founder.
That's right.
Right.
That's right.
And it, like, the idea could be solid. There could be research. There could be all this other stuff going on. But for some reason, there's something that's preventing people from saying, yes, I'm in.
Right.
Have you, tried to uncover that one little aspect? Because let's face it, investors will also 99.9% of the time not tell you why they're not going to invest.
Right.
They'll just disappear.
Right.
Okay? So have you found some of those reasons within this framework to help founders understand how they can present themselves and their ideas better?
Yeah, I mean, for sure. I think a lot of this goes to, what it's the same kind of things we look for, right? I can typically tell how coachable a founder is going to be in a very quick interaction with them, right? What I want to see is the founder who's not necessarily going to say, if I make a suggestion, it's not that they're going to say, hey, I'm going to go follow that immediately. I don't necessarily want to see that. So there's a difference between coachability and kind of rolling over, right? But what I do want to be able to see is that there's real thought giving to, hey, maybe the way I'm thinking about this can evolve. And I think, when I talk to founders and, we're obviously in this business, we get pitched all the time. And that comes through, right? It comes through in the way that they talk about their business. It comes through in the dialogue after the pitch. But that element of coachability more than anything else is key. The other thing, too, Jeff, is that I think really comes through where it's hard for investors to articulate it. It's passion, right? It's that sense of, this is my life's work. I'm not starting this because it looked good on a spreadsheet. I'm starting this because I am so intellectually and personally engaged in what I'm doing here that I can use that engagement. This goes back to creative resilience, right? It's that passion for what I do that's going to make me better as I get boxed into the corner. And if you don't have that, right? If you're starting this because, it sounds great, you're starting the next AI thing because that's what you're supposed to be starting, or, green energy or whatever. I'm not saying any of those businesses are bad. They're great, but you got to be doing it for the right reasons, right? That's
Right.
what I want to see, is that passion is going to lead to that kind of creative resilience. So coachability and passion, they're the two, but it's hard for me to even articulate those things to a founder, right? I mean, it's hard
Right.
for me to even say to a founder, hey, you don't seem that passionate about this. Maybe I will, but that's not, that's a hard thing for an investor to really articulate.
It is. It's one of those soft skills too that comes across, right? Like, because there's passion and then there is exaggeration or aggrandizement. These people that really come across as almost a pushy salesperson,
That's right.
right? And they don't understand there's a big difference between being passionate about the vision and just trying to sell the idea to an investor.
That's right.
I think that it's a tight rope to walk for a lot of these people, and it's challenging for them to understand how to change how they talk, not necessarily what they say, but how they talk to people. But I love this, Greg. We're at time right now. We could talk about this stuff all day long.
Absolutely.
Obviously, there's a reason that's certain. And here's the flip side of this coin. I'm going to say this really quickly.
Sure.
The flip side of the coin is we talked all about the framework for the founders. And we know there are founders out there who will be amazing at raising capital. And you will want to put your money with them, but
Sure.
somehow the idea still flops because they haven't figured out that second piece, which you said earlier. And we didn't even get a chance to go into that. And that part, I think, is equally as hard, if not harder in some cases, especially if you don't understand the industry and the economy and everything else going on.
That's right. That's right.
But I do want to caution people to be careful of that. Now, I end every show, Greg, with one question to you, which is, now that you've gone through everything you've gone through, your ups, your downs, your sideways, and all the successes and failures you've had, What advice would you give to your younger self before you ever embarked on this journey of becoming either a founder or even an investor a long time ago? What's that one piece of advice you would love to be able to go back and give to yourself?
Stop fighting yourself. The, listen, right? It's to me more than anything else, I think just accepting that this is going to be a hard road as a founder, as an entrepreneur. It's going to take a long time, way longer than you think it will. And accepting that you're not going to be able to control the outcomes. You're not going to be able to control every single thing. Give that up. And I spent years as a founder, Jeff, fighting, myself and with trying to just control and micromanage and do things like that. And what I got for it was thinking I was having a heart attack at 35 years old, literally landing in the hospital, anxiety attacks, it's that, but that's not atypical for founders. Stop trying to control every single thing. You have to be able to enjoy part of this journey, right? If this is all about attaching to some outcome, some billion-dollar exit that quite honestly, you're probably not going to have, this is not going to be a fun road for you. You've got to be able to enjoy part of this journey. You've got to be able to really, be grateful for the teams you're building and the accomplishments that they're making and the learning that you're doing. That's the advice. I try to, and look, I have to give myself that advice still today, regardless of anything else.
No, it's great advice. I love that. That's awesome, Greg. So, I know people are going to want to follow up with you. They're going to want to learn, one, about the book that's coming out, right? We're going to be outlining a lot more of this and how they can start taking those assessments themselves because, if everything you're saying, resonates with these people, they're going to want to know how to get that. So how can people find you online and get attracted? I know we got the QR code. But
yeah. So they can just click on that. If I can point to it here. Yeah, there we go. They can just click on the QR code. That's going to take them to a link tree. My contact information is there. There's a link there to take the assessment. It's free. If you're an investor and you're looking at an investment, and you want one of your founders to take it, just have them take it. We're happy to give it out. We're not in the assessment business. We're a venture fund.
Right.
There's a link there. Also, the book comes out around March 1st. So it's probably right around the time this podcast is going to be coming out. There's a link on the link tree also to pre-order it. And you just drop in your name, your email, and then we'll send you a link to Amazon the day it comes out. But yeah, all the information's right there.
Awesome. Thanks so much, Greg. And we'll make sure we put that in the show notes as well for anybody who might be listening to this as opposed to watching it. So, Greg, thanks so much for being on the Angels, Exits, and Acquisitions podcast. And, for those of you out here watching it or listening to it, make sure you go to the show notes, click on Greg's link, and go learn about this assessment and get his book, The Adaptive Innovator. Greg, thank you so much for being here today.
Hey, pleasure, Jeff. Appreciate it.